Hello, everyone. This is Jordan. Welcome to the Daily Gold University. This video is the first video in a series of videos from my book. Welcome to Lesson 1. Let's get started. Gold as an investment is simple to understand, yet muddled by the endless misinformation and disinformation from detractors and proponents alike. We often hear phrases such as end of the world trade, just a rock, flight to quality, you cannot eat it, hedge for uncertainty, inflation hedge, deflation hedge. Such phrases mischaracterize gold and miss the simple fact that gold is the ultimate money. Over 100 years ago, J.P. Morgan said, gold is money, everything else is credit. Gold, and secondarily silver, has been used as money for thousands of years because it better fits the characteristics of money more than anything else. It's durable, divisible, convenient, portable, and has intrinsic value. In today's fiat world, gold is money, but more so an alternative currency that performs well when the value of fiat currencies or perceived value is declining. One way to track any currency's current trend and perceived value is to compare it to the direction of real interest rates or real yields on government bonds. Over the past 100 years, the best indicator of the trend in the gold price has been the trend in real interest rates, which is essentially interest rates minus the inflation rate. Gold will rise when real rates are negative or declining towards negative territory. Gold declines when real interest rates rise, and gold faces long-term headwinds when real interest rates are sharply positive, as they were for the majority of the 1980s and 1990s. Suppose we can earn a real inflation-adjusted return on our capital in a savings account, certificate of deposit, or government bond. In that case, there is no reason to seek alternative currencies like gold. Conversely, capital moves towards alternative currencies when the inflation rate exceeds the interest rate on the securities mentioned above. First and foremost, that means gold, and secondly, silver. There are various ways to measure real interest rates. We will focus on two. One can calculate real rates by subtracting the inflation rate using the Consumer Price Index, or CPI, from the federal funds rate or various bond yields. This works best in a historical and educational sense. The downside is that the Consumer Price Index is a backward-looking index. The second method, established in the late 1990s with the advent of TIPS, or Treasury Inflation-Protected Securities, is a fluid, market-based calculation of real interest rates. The real yield is the difference between the yield on a government bond and the yield on the corresponding TIPS security. According to research from PIMCO, the real yield on the 10-year Treasury note, as calculated from the 10-year TIPS security, has been the best indicator for gold. In other words, gold is inversely correlated to the real 10-year yield. Figure 1.1 plots gold along with the real Fed funds rate dating back to 1914. The vertical lines show the secular peaks in commodity prices and/or gold. The dates include 1920, 1951, 1980, and 2011. Historical secular bull markets in gold and commodities concluded when real rates, after being in negative territory for many years, surged into positive territory. Commodity prices made secular peaks in 1920 and 1951, while gold, which was fixed at $35 an ounce under the Bretton Woods Agreement until 1971, peaked in 1980. Commodity prices peaked in 1920 as the real Fed funds rate exploded from minus 19% to nearly 20%. Then in 1951, commodity prices peaked as the real Fed funds rate increased from minus 7% to almost 2%. From 1979 to 1980, when the gold price went parabolic and collapsed, the real Fed funds rate increased by nearly 15%. It advanced from a low of minus 5% to 10%. Although the real Fed funds rate trended lower after the early 1980s, it was strongly positive for most of the 1980s and 1990s. A reduction from a sharply positive real interest rate to a modestly positive real interest rate did not move the needle regarding gold's fundamentals. The negative Correlation between the trend in the gold price and real interest rates over the past 25 years should be particularly illuminating. The real Fed funds rate declined from 3.2% in 2001 to a low of minus 3.7% in 2011. The decline was interrupted by a sharp but temporary rise of around 6% during the financial crisis in 2008. Then the gold price declined by over 30%. While 2011 was a significant peak in gold and precious metals, it was not a multi-decade peak because real interest rates only increased slightly over the next few years. However, from 2011 to 2015, the real Fed funds rate rose by over 4%. That was the fundamental explanation for the 2011 to 2015 bear market in gold and precious metals. Gold surged higher in 2016 as the real Fed funds rate declined by more than 2% over 18 months. However, gold failed to build on its 2016 gains or break out in 2017 and 2018 due to the nearly 3% rebound in real interest rates as the Federal Reserve raised interest rates. Before and during the COVID crash, the real Fed funds rate crashed as a historic amount of fiscal stimulus and transfer payments, along with interest rate cuts to 0%, caused the highest inflation in 40 years. That spurred gold to break the 1375-ounce resistance level, which had held for the previous 6 years, and reached nearly $2,100 an ounce in August of 2020. Then, gold peaked and consolidated for the following 3.5 years as the Federal Reserve embarked on the second most aggressive tightening cycle in its history. In 2023, it hiked short-term rates from 0% to 5.5%. Not surprisingly, this concluded with a sharp increase in the real Fed funds rate from deeply negative to nearly 3%. There have been some slight discrepancies over the past few years, and to explain them, we employ the better indicator, the real 10-year yield as calculated from the TIPS market. Figure 1.2 shows gold and the real 10-year yield. The real Fed funds rate and real 10-year yield continued to decline after gold peaked in August 2020. How do we explain this and some other discrepancies? In figure 1.2, we see that gold leads the real 10-year yield at important turning points. In other words, the gold price will bottom and rebound before real yields peak and start falling, and the gold price will peak and decline before real yields bottom and turn higher. For example, gold peaked in the summer of 2011, but the real 10-year yield did not bottom until the end of 2012. The gold price bottomed at the end of 2015, but real yields did not peak until 2018. Furthermore, gold peaked in August 2020 before real yields bottomed in mid-2021. The gold market discounted the coming rebound in real interest rates, which was spurred by the Fed's tightening campaign. The opposite occurred in recent years and in stark fashion. The gold price bottomed in October 2022, roughly 1 year ahead of the peak in the real 10-year yield. The real yield rose by another 0.75%, but gold had already bottomed. The real 10-year yield is the best indicator for gold, but we must evaluate the two together because gold leads at turning points. From 2021 to 2023, the real 10-year yield gained over 3.5%. This was an even stronger rise than in 2012 to 2013 and 2008 when the gold price declined 35% and 30%, respectively. Yet the gold price held up much better, declining only 22%, and that was a hint of what was to come in 2024. The market was discounting that the huge rise in real interest rates was not sustainable and would reverse course. Finally, the impact of the new secular bear market in bonds, which we will analyze in Lesson 3, provides a new context for gold's relationship with real interest rates. There are points in time when bonds sell off and yields rise because of inflation or solvency worries rather than an overheating economy. The result is strength in gold amid temporarily high real interest rates. This transpired at times during the 1970s and could be what we have seen very recently. We will discuss additional fundamentals for gold. Still, the overarching reality is that the U.S. and the Western world has a debt problem that can only be solved through ongoing negative real interest rates and high inflation. Over time, this will devalue interest payments to more manageable levels. The yield curve. The yield curve or yield spread is the difference between short-term and long-term yields. It is also a driver of the price of gold. The most common spread is the difference between the 2-year yield, a proxy for the Fed funds rate, and the 10-year yield. A flattening yield curve a shrinking or decreasing difference between the two yields, usually accompanies the middle part of an economic expansion and stock market boom. The curve flattens because the Federal Reserve raises short-term rates, which rise faster than long-term yields. This results in disinflation, a decrease in the inflation rate, which is bearish for gold. On the other hand, a steepening curve or widening of the yield spread is bullish for gold. This can happen in one of two ways. Long-term bond yields can rise faster than short-term bond yields, short-term rates, implying an increase in inflation expectations, or short-term rates decrease faster than long-term yields. That implies risk aversion and a loss of confidence in the economy and capital markets. The yield curve will move from flattening or inversion, short-term rates are higher than long-term rates, to steepening when the Federal Reserve starts cutting interest rates and the economy slows towards recession. In figure 1.3, we plot gold and the yield curve, 10-year yield minus the 2-year yield. We highlighted in yellow periods when gold performed well and the yield curve steepened. As you can see, the flattening curve in the late 1990s and from 2014 to 2018 coincided with gold's decline and lack of performance. The flattening curve since early 2021 also coincided with a stagnant gold market. On the other side, the steepening of the curve into 2001 coincided with the major bottom in gold. The steepening continued after the depths of the financial crisis, and gold continued to rise alongside. The steepening of the curve in 2007 preceded gold's surge above $700 an ounce and to $1,000 an ounce. At present, the yield curve has steepened from deep inversion to positive territory as the Federal Reserve has begun cutting interest rates. The price of gold has already broken out to a new all-time high. If the steepening continues, it indicates that the U.S. economy is in recession, which necessitates further interest rate cuts from the Fed. If the yield curve meanders around zero or slightly positive territory, as it did in the mid-1990s and late 1990s, it could indicate a soft landing or temporary soft landing in the economy, which is negative for gold. U.S. dollar index. We have several important observations in the history of gold and the U.S. dollar. First, the U.S. dollar cannot sustain a real bull market if the gold price rises. However, there are certain periods when the two can trend together. The 2016 to 2020 period and the August 2018 to August 2020 period show that gold can perform well even if the U.S. dollar is stable and not falling. Ultimately, a secular bull market in gold requires a relatively weak dollar over a long period. Secondly, the negative correlation between gold and the U.S. dollar is less than normal on a longer-term basis. For example, the dollar's all-time high was in 1985, but gold's post-1980 low did not occur until 1999. The dollar's all-time low was in 2008, but the gold price rise is much higher today than in 2008. Gold is roughly 150% higher today than in December 2015, while the dollar is at the same level. Here are a few other examples. The dollar's worst decline was from 1985 through 1987, but gold experienced only a modest cyclical bull market. In the 1970s, the dollar's decline was modest, but gold's run was historic. Third, gold performed much better during the recent secular advance in the dollar than during previous secular advances. The dollar gained 56% from 2011 to the peak in 2022. Gold declined 16% during that period. The uptrend from the dollar in 1980 to 1985 and 1995 to 2001 coincided with some of the worst declines in gold, 60% in the first half of the 1980s and 40% in the back half of the 1990s. Moreover, from August 2011 to October 2024, the dollar and gold each gained around 40%. Finally, in studying the recent history between the two currencies, I have noticed the tendency for gold to lead the U.S. dollar at key turning points. In other words, gold can bottom before peaks in the U.S. dollar and peak before troughs in the U.S. dollar. There are numerous examples. During its historic bottom in 2001, gold bottomed more than several months before the U.S. dollar peaked. In the second half of 2005, gold began a significant increase, yet the U.S. dollar rose during the early part of gold's move. After correcting over 30% during the financial crisis, gold bottomed in October 2008, yet the U.S. dollar would not peak until several months later. Gold bottomed in August 2018 and would rise roughly 80% over the next 2 years. The US dollar did not peak until March of 2020. It trended alongside gold for much of 2019. The leadership also works in reverse. Gold peaked in the summer of 2016, and the US dollar declined below its 2016 low in 2017. It reached a new low, yet gold could not surpass its 2016 high. Also, gold peaked in August 2020, but the US dollar did not bottom until January 2021. One way to analyze gold's performance in real terms is to chart it against foreign currencies or the inverse of the US dollar index. A simple way to calculate this is to multiply gold by the US dollar index. Figure 1.5 plots gold, bottom, and gold against foreign currencies, top. There are a handful of examples over the past few decades of gold against foreign currencies leading the gold price at key turning points. In the early 2000s, gold against foreign currencies made a new 52-week high in the spring of 2001, just as gold emerged from its double bottom. Several years later, in the middle of 2005, gold against foreign currencies made a major breakout to the upside. Gold followed several months later. Gold against foreign currencies provided another important divergence during the financial crisis. It bottomed a few months before gold bottomed in late 2008. Gold against foreign currencies broke out to a new high in early 2009, months before gold did. Finally, gold against foreign currencies broke to a new all-time high in August of 2019, a year before gold, and the same occurred when gold against foreign currencies made a new all-time high in March of 2023, a year before gold did. There are also examples of gold against foreign currencies lagging the gold price and not confirming its strength. Note the red arrows in the mid-1980s and mid-1990s. Gold made higher highs during these periods, yet gold against foreign currencies did not. In 2017 and into early 2018, the gold price was making higher highs, but gold against foreign currencies did not confirm that. Non-confirmations from gold against foreign currencies can lead to declines in the gold price. Gold against foreign currencies reflects how gold is performing without the impact of a falling dollar. If gold is rising, but gold against foreign currencies is weak, then it is a sign of a weak US dollar and not strength in gold. If the dollar is climbing, but gold against foreign currencies shows strength, it is a signal of strength in the dollar more so than weakness in gold. The US dollar appreciated gradually from 2011 to 2022, but gold held up far better than it did during the past periods of US dollar appreciation. The reason is that gold against foreign currencies has been considerably stronger than in the 1980s and 1990s. In other words, gold has been much stronger recently against all other currencies than in the 1980s and 1990s. Supply and demand. The supply and demand dynamics for gold are entirely different from other commodities. The vast majority of gold is not consumed as there is little industrial use for it. Therefore, its supply grows virtually in perpetuity. The majority of demand comes from jewelry and investment demand, which drives the trend in the price of gold. When the price of gold rises, jewelry demand falls. Conversely, jewelry demand increases when the price of gold declines. Investment demand is the mirror image of jewelry demand. It correlates positively to changes in the gold price. Figure 1.6 from precious metals consultancy firm CPM Group reflects the importance of investment demand. Investment demand tends to increase in years of an increase in the gold price. When gold has bullish fundamentals, such as declining real interest rates and a steepening yield curve, investment demand increases materially, and the gold price rises. If investors discount rising real interest rates and weaker fundamentals for gold, investment demand declines, and so does the gold price. Central bank buying. Other categories of demand include investment and jewelry demand, technological demand, and central bank demand, whose impact is far different today than in decades past. Central banks were net sellers during most of the 1970s to 1980s and 2001 to 2011 bull markets. They became net buyers only at the very end of those bull markets. Shown in Figure 1.7, central bank demand has historically been somewhat inversely correlated to the gold price. The boxes signal the previous secular bull markets during which central bank demand was sparse. However, central bank demand has emerged as a major source of demand alongside investment demand and has transformed the gold market. Since the major low in the gold price at the end of 2015, the two most important price lows were around $1,045 an ounce in 2018 and around $1,620 an ounce in 2022. In 2018, central banks bought 651 tons of gold, the second highest in history. Central bank demand exploded higher in 2022 to over 1,000 tons, putting a floor in the gold market as it endured the impact of rising real interest rates. According to the World Gold Council, central banks bought 1,082 tons in 2022 and another 1,037 tons in 2023. Furthermore, demand through the first half of 2024, 483 tons, is only marginally lower than the past few years. The fact that the level of central bank demand in 2022 continued into 2023 and in the first half of 2024 as the gold price broke a new all-time high signals an important change. Central banks were net sellers during the strongest periods, 1970s and 2000s, and the 1990s. They only began buying at the end of the previous secular bull, and that continued through the entire secular bear market, 2011 to 2023. Their consistent buying in recent quarters speaks to something larger on the horizon. Outside of the United States, the world is gradually moving away from the US dollar as a reserve currency. The economic and financial reason is because the US fiscal position is increasingly concerning, which we will focus on in Chapter 6, or Lesson 6. The geopolitical reason is countries are reacting to Russia being cut off from the SWIFT payment system and the potential seizure of their assets in the United States by the United States. Gold protects sovereign nations from this type of geopolitical and counterparty risk. This kind of geopolitical development drives gold far more than a flare-up in some hotspots in the Middle East. After seeing figure 1.8 from Gainesville Coins and @YonGold, we understand why central bank demand could be consistently strong over the years ahead. Gold's share of international reserves has only begun to increase in recent years. It reached 18% in 2023 and 21% in late 2024. During the bull market in the 1970s, it increased from below 40% to nearly 65%. Global gold production. Gold is not consumed, unlike other commodities, so its supply grows in perpetuity. Gold moves on the margin due to monetary factors and investment demand. Broad supply and demand and production fundamentals for gold do not impact the price. Figure 1.9 shows the annual global output and demand for gold. Demand consistently grows higher over time. Note that there was a growing deficit between demand and production from the mid-1980s until 2003. Gold remained in a secular bear market for the vast majority of that period. We can make one interesting observation regarding the global production of gold. From the chart, one might think that the production impacts the gold price. It declines when the gold price rises, but rises when the gold price falls. I credit the late Heinz Blasnik, who wrote under the pseudo-names Trotsky and Peter Tenenbaum, with a great explanation courtesy of Mike Mish Shedlock. According to Blasnik, mining companies are forced to high-grade their mines during low gold price environments. In other words, they mine the high-grade portions of deposits, which result in lower unit costs. However, when the gold price rises, mining companies can mine the lower-grade portions of their deposits, which results in higher unit costs. In addition, the impact of the gold price on future supply operates with a considerable lag. Gold bull markets lead to greater exploration spending, which leads to future production. However, the gold bull market has to run its course by the time those new mines are operating. Furthermore, the impact of a gold bear market on future production is not realized until gold is already back in a bull market. The inverse relationship between global gold production and the gold price has continued in recent years. Production declined from 2018 to 2020 when the gold price enjoyed a cyclical bull market and increased in 2021 when the gold price declined. Chapter summary. Gold is unique in the commodity complex because its drivers are related entirely to monetary factors and not typical supply and demand fundamentals. Gold is inversely correlated with real interest rates. Gold will rise in value when real interest rates decline to or below zero, and gold will fall when real interest rates rise. The best indicator for real interest rates is the real yield on the 10-year Treasury note as derived from the TIPS market. It is important to note that the gold price usually leads real interest rates at market turning points. It will bottom and rebound before real interest rates decline, as evidenced by the 2022 to 2023 period. Gold will also peak and decline before real interest rates bottom, as evidenced by the 2011 to 2012 and 2020 to 2021 periods. Secondary drivers of the gold price include the yield curve, the US dollar index, and central bank demand. Gold also leads the US dollar index at key turning points. it is important to chart gold against foreign currencies, similar to gold multiplied by the US dollar index, to determine gold's performance in real terms. Gold against foreign currencies is also a leading indicator of the gold price. Central bank demand has become a new driver for gold and helped the price to bottom in 2018 and 2022. There are multiple reasons why central banks are likely to continue buying gold in the years ahead. That is the end of Lesson 1. Next up is Lesson 2, in which I will discuss gold's very important relationship to the U.S. stock market. Thank you for joining me.